So, hello everyone. Welcome to Dhan podcast. And today we have with us one of the most eminent personalities in recent times. We have with us Mr. Gautam Baid. Gautam, thank you so much for taking your time out of your busy schedule and agreeing to do a podcast with us. So it's really been a privilege for us. Just to introduce, Gautam is a fund manager. He's based out of US, and we all know him for his famous book called The Joys of Compounding, which has become the bestseller in a lot of countries now. Gautam, I have read your book. It's fantastic. It doesn't speak about, not only speaks about finance, but speaks about all aspects of life. So it's a wonderful read actually, and I would recommend all the users here that if you still have not read it, you should buy out and start reading it. Gautam, before we get into the discussion, so since you are from Calcutta and being a fellow Calcuttan, it gives another level of pleasure to interact with someone, especially in the kind of Hindi which we use in Calcutta, which is unique of its own.
True.
Yeah. So, Gautam, how has been your journey early days? Can you just share your thoughts on, can you share about your journey during your studies at Kolkata and how has been your social circles there?
Sure. So I've been born and brought up in the city of Joy, Kolkata, and I come from a Marwadi family. And as many of us know, business basically flows in the genes of the Marwadi community in India. So ever since my early teenage years and school years, I was very fascinated by the concept of business and entrepreneurship, especially by the fact that once a solid foundation has been established for a business, the owners do not work for money, rather, money works for them. I did my graduation with a specialization in accountancy, and after that, pursuing higher studies in the field of finance seemed like a natural extension. So, I did my MBA in finance from Nirma University, Ahmedabad, and I also did my Indian CFA from ICFA University, Hyderabad. I also did my international CFA from the CFA Institute, US. And after completing my MBA program, I got a campus placement with Citibank in Mumbai as an analyst in their investment banking team, and I worked there for 3 years. And from there, I joined Deutsche Bank as a senior analyst with their investment banking team, where I worked for 4 years at their Mumbai, London, and Hong Kong offices. As regards how did I get my beginning in the stock market, as is typically the story of most new investors, I was attracted to the stock market during the final euphoric phases of a bull market. In my case, it was the 2003 to 2007 bull market in India. I still remember I had invested in a mutual fund called Reliance Power Sector Mutual Fund in late 2007 and a stock named Ispat Steel in early 2008, January 2008, because both of these were in the hot and fancied sectors of power and steel at the time. And I paid no heed whatsoever to their business models or valuations. I simply extrapolated the recent price trends in them without actually paying any heed to the fundamentals of the business. And I paid my price. Both those investments crashed 70 to 80% within 12 to 18 months of my purchase, and I had successfully gained my admission into the stock market by paying my tuition fees. Despite this bad initial experience, my interest and enthusiasm about the stock markets remained very high throughout the first 7 years of my professional investment banking career. And one fine day, I came to the realization that I just have this one short life to live my dream, and I do not want to waste any further time doing or working in something which I'm not truly passionate about. You see, the problem with many people and families around the world is that if you're earning a very high income, then people equate a high salary income or high job income for happiness. But true job satisfaction or true happiness actually is found when you live a life which is aligned with your personal value system and your passion. And I was very passionate about the stock market. I was not very happy with the field of investment banking. It did not suit my personal nature because most of investment banking is basically a win-lose relationship type game. But the stock markets in aggregate are a win-win game if you practice good, solid, long-term value investing, because a lot of value creation is actually taking place for everyone involved. So I quit my job in 2015 and I relocated to the US. My brother, who is a US citizen, he sponsored my green card, and I came to the US thinking that since I'm a CFA charter holder, I'll get a very good paying stock market job very easily because this particular CFA designation is highly valued in the stock market job industry there. But life is not a bed of roses for those trying to carve their own destiny. I got rejected in the first three stock market job interviews in the US because I did not have the relevant work experience nor the requisite knowledge. At the same time, I ran out of whatever little money I had brought with me from India, and to sustain myself in the US, I did not want to sell even a single share from my portfolio of Indian stocks because I did not want to interrupt the process of compounding. So I took up a minimum wage job as a front desk clerk at a hotel in San Francisco, California, where I used to work during the graveyard shift. Now, for those who don't know what that means, it was a shift which ran from 11 p.m. at night to 7 a.m. in the morning, and I worked there for 15 months. And every single night, I still remember, I used to apply to a minimum of three stock market jobs online. So if you just do this a simple math, over those 15 months, I had applied to more than 1300 jobs. To face rejection more than 1300 times and still keep on going is only and only possible if you're absolutely fiercely dedicated and passionate about what you want to pursue in life. Because every single time you fill out the job application, attach your resume, and click on the submit button, there is so much hope attached behind every single submission. But this is how compounding actually works. Compounding will bestow its magic and benefits upon you only after testing your patience and conviction to the fullest. During one fine night in November 2016, while working at the hotel, I randomly clicked on the quick apply button on a job application on LinkedIn. And wonder of wonders, I was shortlisted for the interview, that too for a senior role in an investment firm, even though I had zero formal work experience in the stock market. And this was the time when I was about to realize the power of compounding knowledge in action. During those previous 15 months at the hotel, the pace of work during late night to early morning was pretty slow, and I made full use of the free time I had to read every single blog article ever published from inception till date on blogs like Safal Niveshak, Janav WordPress, Basic Investing, Fundu Professor, Macrocap Club, among others. And the passionate pursuit of lifelong learning had finally begun. And this time, I had the rigor and the strong foundation in terms of the investing knowledge. So I was able to excel in all the three rounds of my job interview this time, and I was offered the role of portfolio manager of global equity strategy with Summit Global Investments in Salt Lake City, Utah, in the US. And I was for the next 4.5 years when I was working there, I was actually getting paid to learn every day, and I used to just love my job. But eventually, decided that okay, I've managed to pursue my passion of tracking the stock market. But at the end of the day, this is the US stock market I'm tracking. My real passion is in the Indian stock market. So last year in July, I quit my job to set up my own investment firm, Stellar Wealth Partners. We got the SEBI Research Analyst license first, and we offer a small case list of stocks for retail investors in India. And we have also got the FPI license, Foreign Portfolio Investor license in the US. And through that, I offer Stellar Wealth Partners India Fund to accredited investors in America. So I'm very excited to bring the investment opportunity which India presents to investors in the US. So that in a nutshell is my journey.
Yeah, wow, that's been amazing journey. So Gautam, you're speaking about stellar investments and you have created some India specific fund. So I have two questions there. So what made you think about India specific fund? How do you see India in next coming years? That's one. And second is if you can share some insights about the fund which you are running with our audiences, that would be great.
Sure. So when I was working as portfolio manager of global equity strategy for those 4.5 years at Summit Global, India as a stock market very clearly stood out to me in terms of the number of high growth opportunities it offered. And no other stock market in the world, in my view, comes close. The US may be a close second because US tech is a very high growth area. But I think no stock market, fundamentally speaking, actually comes close to the opportunities which India presents today. That's why I decided to launch a India only investment vehicle in the US. It's a benchmark agnostic portfolio of 25 stocks.
Mhm.
And, the big picture idea here is that if we just simply look at history, if you look at the history of US, Japan, and China, all these three large economies, when those countries' GDP doubled from 2.5 trillion to 5 trillion, their stock markets did not just double. Their stock markets tripled or even quadrupled. And why did that happen? It's because when a nation transitions from a low income per capita country to a middle income per capita country, the basic spending on items like food does not go up much, but the spending on branded discretionary consumption and financialization of savings, these two categories simply explode. And we're already witnessing this very phenomena taking place in front of our eyes in India. Today, India is at $3.3 trillion of GDP. Let's go 3 years in time when India was 2.5 trillion and see what has happened. So, during the course of this journey from 2.5 trillion to 3.3 trillion, 3 years ago, the number of demat accounts in India was 3.5 crores. Today, the number of demat accounts in India is more than 11 crore demat accounts. So, this financialization of savings element, which I talked about, is already witnessing an explosion right in front of our eyes in India. Secondly, which is the category which has been doing exceptionally well over the last 2 years? It is urban India branded discretionary consumption. Rural India is struggling. Consumer staples are struggling, but aspirational yet affordable categories in India, those categories are the ones witnessing exponential growth. This is where a portfolio manager who should ideally position his portfolio in India for long-term success over the next few decades. Because as India transitions from a income per capita country to a middle income per capita country, tremendous amount of wealth is about to be created. If we simply assume that the market cap to GDP will approximate one over the long run in India, and we know that over the next two decades, trillions of dollars of GDP is going to be added, one can just envisage the kind of wealth creation that lies in store for investors in great Indian businesses. Trillions of dollars. We are talking trillions of dollars here in wealth creation over the next few decades. This is the time to think big in India. This is not a time to think small. And which are the companies or businesses in India that will capture the bulk of this upcoming wealth creation boom? The nation's best managed businesses with proven ability to scale up their operations and execute. They are the ones who will capture the bulk of this upcoming wealth creation boom in the Indian stock markets. This is also known as the power law. And this power law holds true in almost every stock market in the world. You look at the US stock market between 1926 and 2016, only 4% of listed US equities accounted for 100% of the market cap addition, as per a study published by Professor Beidenberg of the University of Arizona. Same thing has been playing out in India as well. Between 1990 and 2018, only 1% of listed Indian equities have accounted for 100% of the market cap addition. That's a startling statistic. Just 1% of all stocks in India have accounted for 100% of the market cap addition over the last, during that 28-year period. So this is why active investing is so difficult. And it's so difficult to beat the index over the long run for most fund managers. It's very, very important for the fund manager to have a very strong investment philosophy, and more importantly, to have the temperament to withstand the volatility in the stock markets for long-term success.
That's wonderful. That gives us a lot of confidence being in India, that how somebody outside India looks at our country, and as you rightly said, right, the next decade belongs to India. So we hope that will be a great economy, at least a third in terms of GDP. I hope by 2035. So coming back, Gautam, on value investing, so you speak a lot about value investing and you believe in that. So in current context, when we have seen that there has been a lot of run up which has happened, all the stocks have been trading at lifetime highs, primarily due to the liquidity push which was available all these years. So in Indian context, when everything has run up, and in India there is a general perception कि जो stock नहीं चला है तेजी में ना उसमें कुछ problem है. So at this point, how you would identify value investing in India?
So it's very important to differentiate the stock from the business, and to differentiate stock price movement from the fundamentals of the business. Just because a stock has not gone up doesn't necessarily mean that the business is a fraud or a cheat, or that the business there's some problem with the business. Sometimes stocks just stagnate for long periods of time, and then they eventually catch up with the fundamentals and earnings. So if you look at the stock price movement history of stock like Titan, for example, we know that it is a massive wealth creator over the last few decades. But there have been many 3 or 4 year periods in between when the stock basically did nothing, gave 0% returns, because as fundamentals backfill and this stock price just waits for earnings to catch up, you'll have periods when these quality businesses go through a time correction, and that's absolutely fine as long as the long-term growth trajectory is in place. One should not be in hurry. One should not be in hurry to sell out of these great businesses, and this is where having a diversified portfolio of high growth businesses comes into the picture. So if you look at how a normal portfolio behaves, one third of the portfolio will be stagnating or even declining at times. One third of the portfolio will be performing average, and one third of the portfolio will be performing exceptionally well. That's how a normal portfolio actually behaves in real life. If all your portfolio stocks are firing up at the same time and going up rapidly, then you can be rest assured that you're near the fag end of a raging bull market, and a big bear market is just around the corner. So, you should have a good diversified portfolio construct and let the businesses and the managements execute. As regards how to look at value investing in these times, there is no dearth of opportunities in the Indian stock market. I always tell people that the Indian stock market is a never-ending stream of constant opportunities. Even in the last few months, when the indices were at record highs, you still got value out of certain special situations. So generally, what happens is in heated markets or overvalued markets at the index level, you should avoid going down the quality curve to chase returns, because once the bear market comes after the bull market, then these low quality stocks simply get decimated and you never recover your capital. You incur permanent loss of capital. A better way to look for value or cheap valuation in a overall expensive market is to look at special situations and to look for elements of forced selling. So what does forced selling mean? So in India, we have this concept of demergers, and within demergers, the biggest money is made in two situations. One is a market cap demerger. One is a sectoral demerger. Let me give an example, not a stock recommendation. This is just to explain how demergers actually work and how you can get cheap valuation during periods of forced selling. So a few years ago, in August 2020, a microcap called Aarti Surfactants was demerged or spun out of Aarti Industries, and Aarti Surfactants was listed as a tiny microcap because Aarti Industries had got institutional shareholding. So when those big funds received shares of this microcap stock, Aarti Surfactants, they didn't want to have anything to do with it. So they started dumping shares of Aarti Surfactants in the open market at whatever price they could get. And the stock price of Aarti Surfactants fell 50% post listing because of this forced selling in the short term by those institutional investors of Aarti Industries. Now let's talk about, so this is a market cap demerger. Second is a sectoral demerger. So Jubilant Ingrevia and Jubilant Pharmanova was spun out of Jubilant Life Sciences, which was primarily held by many pharma funds. So when those pharma funds received shares of Jubilant Ingrevia, a chemicals company, by the rigid mandate, they were not allowed to hold on to a stock of a chemical company, even though the market cap was of decent size. So again, you got this element of forced selling, and Jubilant Ingrevia fell 40% post listing after the demerger. So again, you were able to buy into a decent quality business at a very cheap price and make very good returns over the next 6 to 12 months. So market cap demerger, sectoral demerger are areas where you get forced selling, and that is where you can get very good value in decent quality businesses. That's one. The second source of value in overheated markets, apart from demergers, is what I call merger arbitrage. Okay. So again, I'll give you a live example. So in the last over the last 1.5 2 months, the stock of Equitas Holding has gone up by more than 30%. For every share of Equitas Holding, you will get 2.31 shares of Equitas Small Finance Bank. 21st December is the record date for getting the NCLT approval. That's the final step for getting this merger through. And if once that merger is approved, then you would get 2.31 shares of Equitas Small Finance Bank. If you simply look at the current stock price of Equitas Small Finance Bank, multiplied by 2.31 and compare it with the stock price of Equitas Holding, you will notice that there is a 10% arbitrage basically to be had, assuming that the merger gets approved on 21st December. So this is how you can actually get good value even in overrated markets. Demergers, forced selling, merger arbitrage is one more. The third and final category which I focus on is promoter and management change, because if a good underlying business asset is being mismanaged by a bad promoter, when that kind of a business is taken over by a new incoming promoter with a very strong past track record of execution and good corporate governance, you get a recipe for multi-baggers, because the underlying business is good, just that the stock markets do not like bad corporate governance. So corporate governance overrides business quality any day. So once a new good promoter comes in, then you make a really good returns from that situation also. So do study special situations in overrated markets.
Okay, that's wonderful. So Gautam, this also brings me to the fact that most of the investors, or rather market participants, they believe that tracking PE multiple, price to book value ratio, gives an understanding whether it's a value investing or not. What's your thought on that?
It's very simple. You know, a low P stock is not necessarily cheap. A high P stock is not necessarily expensive. To
Correct.
understand the justified P multiple for a business, and all investors should read two white papers, which I've referenced to in my book as well. First white paper is titled "What Does a P Multiple Mean?" It's by Michael Mauboussin. The second white paper, which I highly recommend to everyone, is "The P Ratio: A User's Manual" by Epoch Investment Partners. Just read these two white papers to understand how the interplay of return on invested capital and growth determines the justified P multiple for a business. In fact, there are certain businesses in which, if you have the longevity of growth for the next 20 years, and along with a very high return on capital employed, and even an entry PE of 70 to 80 P multiple is justified, and you still are making very good money from such high entry valuations. The key is the longevity of the growth. So when you're paying high P multiples or very expensive valuations for a stock, just try to ensure and try your best that you get the longevity of growth correct. That will basically pay for the high valuation which you're paying. But if you get the longevity of growth wrong, then you can have valuation derating and you'll end up with permanent loss of capital. So that's why it's much more safer to stick with lower valuation companies. But it's fine to pay high P multiples also, as long as you're absolutely confident about the longevity of growth.
Okay, that's great. Yeah. So Gautam, my next question is with respect to the majority of the population in the country who have become market participants in the last 3 years. If you see, the majority of them are less than 35 years of age. When you are at that age, you probably have started earning maybe for a couple of years. You are the first time in market participant. So for them, and also because of the age, right, it becomes very pertinent that they want to take more risks. They have this they are driven by instant gratification thing. They always feel that there is a fear of missing out. For those category of investors or market participants, if they have to build their portfolio, for them it feels like 5 saal hold karna, it's a pretty boring thing. Who will wait for that? So how would somebody wants to get into a wealth creation mode, and also given the peer pressure and the social pressure they would face if they start investing for 5 years? So for those kind of listeners, what would be your message to them? What they should stick to?
The first and most important message I would share with them is there is nothing like peer pressure or social pressure. Investing is not about beating others at their game. It's about reaching your own personal financial goals in an appropriate amount of time with the least amount of risk. That's it. It's investing is a solo sport. It's not a team sport, and it's all about your individual risk appetite, your individual risk tolerance, your individual temperament. Play the game in which you're best positioned to win. I always tell people that the best investing strategy is the one which you can stick with for the longest period of time, because time is the biggest contributor to in the compounding equation. If you look at the compound interest equation, T or N is the only element which is in the exponent. It's an exponential function. So ideally harness the exponential power of time in the compound interest equation, and you have to invest for the long term. And here, let me be very clear. When I say long-term investing, I'm not talking about being invested in a single stock or an individual stock for the long term. I'm talking about remaining invested inside the stock market for the very long term of 15, 20 years, because you'll end up experiencing 2, 3 very big bull markets in that period of time. And if you can just survive the bear markets in the interim, which you'll face, is the only road to riches. If you can just survive the bear markets over the next 15, 20 years, the bull markets by themselves are so powerful. You can't help but become rich as a result, because in a raging bull market, in a proper bull market, which are sectoral bull markets, basically, if you can get hold of even some of the big sector leaders or big winners, your overall portfolio goes up multiple times in a bull market. And if you don't give up all of the gains in the subsequent bear market, you'll be financially independent by the end of it. So focus on your individual goals and Also, when you're early in your career, focus on increasing your cash flow, focus on increasing your income, focus on building your career first, focus on building your portfolio later. First, focus on your career. And this is very, very important, because this is a place in which capital or money is the raw material, right? So you should focus. The big learning which I've got from Warren Buffett and Charlie Munger from Berkshire Hathaway is that the real game is to have multiple sources of recurring cash flow. You want to build up as many sources of cash flow as you can, because whenever the market goes through its periodic corrections and bear markets, you want to have cash to deploy, because that is when you get the best bargains. So focus on your career, and also focus on building as many sources of cash flow, passive income preferably, outside your job if you can.
Okay, that's great. So Gautam, this brings me to the another point. Most of the investors now, they prefer to be an active investor. They want to chase alpha, they want to beat the benchmark indices. So what do you believe? A passive investing is something which works for someone who wants to build a career, keep investing and don't look into that, keep generating, more cash flows so that you are better prepared to be in the market, or active investing? Which one you would suggest?
The natural progression for an individual investor, which I recommend to everyone, is start off with basic index funds, then go to actively managed mutual funds, then focus on small cases, then probably to a PMS, and then finally you can also look at direct stock investing. But if you can do direct stock investing yourself, then you don't need to go for a small case or a PMS or any other vehicle. You can do it yourself. But if you cannot invest on your own, then this is the typical progression which people should follow: index funds, actively managed mutual funds, small cases, and PMSs, and then probably an AIF after that. But that is the normal progression which most know nothing investors should follow if they don't know how to pick stocks themselves.
Okay. So Gautam, we are hearing all around about the global recession. The way things are changing. So probably our generation, right, would not have seen the kind of inflation which we are seeing in the West now. The last time the inflation was in double digits or close to double digits was in 1980s. So till the beginning of 2022, it was nearly zero. So the new set of investors who have spent time in the market for say 20 odd years, for them it has always been a low interest rate regime. So do you think the whole investment philosophy is going to change going forward, when you'll always have higher inflation, higher interest rate? Interest rate of 4.5% in US on a government security or on a safe instrument is something which nobody would have thought of maybe a couple of years back.
That's what the problem in most investors in the stock market is, that they are not studying history long enough. In fact, as recent as the year 2000, the US 10-year bond yield was 6%, but but today at 3.6, 3.7%, people are making such a hue and cry about it. And you talked about change of investment philosophy. Is it required? And investment philosophy is not something that is available next door. It is something that is built up over time, over many years, sometimes even decades. So if your investment philosophy has to be modified or changed as per the interest rate cycle or the market cycle, then it's not a robust investment philosophy. A sound investment philosophy is one which is durable and robust across all market environments, which can withstand global supply chain shocks, a war in Europe, COVID-19, nationwide lockdowns, demonetization, GST disruptions, commodity price volatility, political party changes. That is what a good investment philosophy is, which can thrive in all kinds of environment and survive and take you through to the other side after a few decades amid all these macro turbulence. That is what a good investment philosophy is. And this is why you just have to focus on value, focus on bottom up stock picking, focus on individual businesses. And if you're investing in cyclical and commodity businesses, just make sure that you exit in a timely manner, because a lot of wealth destruction happens when you enter these commodity and cyclical businesses near the peak of their cycle at their peak operating margins. So have a very disciplined exit strategy in place. For example, you can make use of a break of a moving day average, like the 21-day moving average or the 50-day moving average. Whatever method you use, or you can have a trailing stop loss from the peak price of 15% once you have had multi-bagger returns on those commodity cyclical stocks. Whatever method you use for your exit, just be disciplined to it and stick to it. You have to be unemotional when you try to when you in your exit strategy in these cyclical and commodity businesses. But you can afford to be more patient with the high quality great businesses, and there are very limited handful of them in India. So once you get hold of them at an early stage or at a small cap or mid cap market stage, then you want to just hold on to them and just ride through the volatility to reap long term wealth creation.
Yeah, that's an interesting insight. And to all the listeners out here, shifting your goalposts, shifting your investment philosophy does not, yield you much in the long run. So, Gautam, how much time one should spend in the market, to decide on what kind of investment philosophy one should have, or to understand what his or her own temperament, whether he's a long-term investor, cyclical player, or how one should decide that, and how much time one should give to understand that.
At least, I think once I've gone through at least two bull and two bear cycles, I think that's broadly a decade. I think that's good enough time to. By that time, most people generally have a investment philosophy buttoned down in place. Took me around a decade or so as well. So took time. In fact, till it was the 2018 and 2019 bear market in the small cap and mid cap space in India, which actually helped me tremendously. My portfolio was down quite a bit in those 2 years, but it really greatly helped me develop a very strong investment philosophy because we have a very short memory. We forget that India was experiencing a very sharp and severe slowdown in economic activity in those 2 years. From January 2018 to March 2020, the small cap index fell 65%, mid cap index fell 55%, and hundreds and thousands of stocks in India fell 70 to 80% over those 27 months. It was a brutal bear market, the biggest I've ever faced in my investing journey. But those 2 years taught me two big lessons: focus on quality above all else, and number two, focus on prudent diversification. Because before that, during 2017, I was a very concentrated investor, and that too in very cheaply valued businesses of mediocre quality, a lot of commodities, cyclicals, and those stocks did very well in 2017. But in 2018 and early 2020, that is when during that phase, I really evolved as an investor. Got to learn a tremendous deal in those 27 months.
Okay, that's great. So even in the recent COVID time fall, we have seen that the people who have experienced 2008, 2009 crisis, they were much better prepared to take advantage of it because of the learning which they had over this span of 10 years.
True, true, true. I mean, real life experience is like gold in the stock market, and the same patterns keep repeating again and again. The same human elements of greed and fear, they are just omnipresent and they keep occurring all the time. If you can just control your personal behavior and follow a good research process, you can't help but become successful in the stock market because there are only two things, right, which we can control as investors: our research process and our personal behavior. There is nothing else which we can control, and this is such a humbling realization. This is when you mature as an investor and start respecting the market a lot more.
Yeah, that's wonderful. So Gautam, we had a lot of intense discussions. So we want to understand the other side of yours. So what do you usually do on when you are on holidays or when you have weekends?
So I'm like most regular guys, which you would probably know about. I love traveling. I love going on vacations. I love spending time with my friends and family. I like going out for movies. I like dining out. So it's just like any other most regular people. But the primary passion is the stock market. But it's good to have a good work-life balance. So in the free time, I like to devote my time to these activities. And I'm also a very voracious reader, so I love reading books whenever I get some free time.
Okay. So that brings me to another very important question. What book you would recommend to someone who has just started his journey in stock markets, maybe the COVID era, segment. So where they should focus on?
For new beginners in the stock market, there are a few fundamental books which they should definitely read. First one is One Up on Wall Street by Peter Lynch. Very good primer on stock market investing. Common Stocks and Uncommon Profits by Phil Fisher is an excellent book on long-term patient investing in high-quality businesses. And they should also read The Most Important Thing by Howard Marks to get a good grip on market psychology and developing a good temperament for investing. So these three books are very good reads for any beginner in the stock market.
I hope you found this interaction very insightful, and it's always been a pleasure to interact with Gautam. Whenever you speak for him for 5 minutes or 30 minutes or an hour, you always take away some valuable insights and lessons from him. Thank you, Gautam, for taking your time out, and I have to thank you once again. So we would always look forward to meet you in person whenever you are in India next time. Thank you so much for taking your time out.
Thank you, Jay, and I wish the team at Dhan all the very best. You guys are doing a great job for the investing fraternity in India. So all the best, and I wish all the viewers all the best in their investing journey. Thank
Thank
you.
you so much. Thank you.